Hello, this is Dr. Ware from the Accounting Kid. Today's lesson will be on the basic accounting equation with a focus on owner's equity. I will explain the basic accounting equation and we will analyze a few business transactions using this equation. Okay, so the basic accounting equation is assets equal liabilities plus owner's equity. Assets are resources owned by a business, which include cash being the most liquid asset, buildings, equipment, land, supplies, inventory, accounts receivable are examples of assets. Liabilities are debt obligations that the business have to creditors. So a liability is money owed to creditors. An example of a liability would be accounts payable, notes payable. It could be a mortgage. It could be bonds payable. Unearned revenue is a liability. And then you have owner's equity. Owner's equity represents ownership interest in the business. This is how the owner computes their interest, ownership interest in their company. The expanded accounting equation, we expanded the owner's equity section, as you can see here. Owner's capital less owner's drawings plus revenue less expenses. There's two ways to increase equity in a business, and there's two ways to decrease equity. The two ways to increase equity are to invest capital, invest money into the business that will increase your equity, and to generate revenue will also increase your equity. The two ways to decrease equity in a business are by owner's drawings, meaning the owner withdraws money from the business account that will decrease equity, and by incurring business expenses. It could be salaries and wages expense, supplies expense, depreciation expense, but rent expense. But expenses decrease equity in the business. So your expanded accounting equation, assets equals liabilities plus owner's capital less drawings plus revenue less expenses. All right, here are a few business transactions. We're going to use the expanded accounting equation. We're going to analyze these business transactions. All right, owner invested $30,000 cash in the company. It's important to remember that each transaction has a dual effect on the accounting equation, meaning that every business transaction will impact two or more accounts, whether those are asset accounts, liability accounts, or equity accounts. But every transaction will have an impact on two or more accounts. All right, the second transaction, the owner purchased equipment for $10,000 cash. Third, purchased $500 of supplies on account. Fourth, provided services to customers for $1,200 cash. The fifth, performed $900 in services on account. Sixth, paid $1,500 for rent. Seventh, paid $200 utility bill. And the last transaction, owner withdrew $5,000 for personal use. So let's take a look at these transactions. Let's analyze these transactions utilizing a transactional analysis. Okay, so we're going to analyze the effects on the appropriate accounts. So the first transaction, the owner invested $30,000 cash into the business. The owner wrote a $30,000 check from a personal account to the business account. Alright, so the owner deposits the $30,000 into the business. Alright, so what happens here, your cash per books is going to increase by $30,000 because now the business has $30,000 cash. And also, the owner's capital increases by $30,000. So after this first transaction, the owner now has $30,000 in equity in the business. The second transaction, the owner purchased equipment for $10,000 cash. Okay, so the cash account decreases by $10,000, and the equipment account, which is also an asset, increases by $10,000. Okay, so your accounting equation is still in balance after the second transaction. After the second transaction, you still have $30,000 in assets, and on the other side of the equation, you have $30,000 in equity. The third transaction, the owner purchased supplies on an account. This means the owner went to the supply store and purchased supplies on credit. Okay, so the owner did not pay for the supplies yet, did not pay cash. The owner purchased the supplies on credit from the supply store. So your supplies increased because as the owner, the supplies were received. So supplies increased by $500. Accounts payable is the liability account that also increases. Your obligation increases. Now you have a $500 obligation to creditors. Okay, so that increases by $500 as well. The accounts payable. So the equation is still in balance after the third transaction. The fourth transaction, the owner provided $1,200 worth of services to customers. So the owner received $1,200. Cash increases by $1,200, and revenue increases by $1,200. The fifth transaction, the owner performed $900 in services to customers on account, on credit. This means that the services have been performed, and they were performed on credit. Therefore, your accounts receivable increases by $900, and your revenue increases by $900. Okay, so the business has not been paid yet for the services performed, but we still recognize the revenue. Accrual basis accounting, revenue is recognized when earned. Revenue is earned when the services are performed or the products are provided to the customer. You recognize that revenue on your books. Even though you have not received the cash yet, you'll invoice the customer later. It could be net 30, net 15, net 10, whatever the case may be. You'll invoice the customer later, but you know the customer owes you money because there's $900 in accounts receivable. The sixth transaction is a rent expense. The owner paid $1,500 in rent. So the owner wrote the landlord a check for the space that is being leased for $1,500. So that's going to increase your expenses and decrease your cash. So if we look at cash is decreased by $1,500, and if you look at the expenses, expenses increased by $1,500. All right, that will be accounted for as a rent expense. So that's a separate account, expense account, rent expense. You will have different account titles for all of your expenses. The seventh transaction, the owner paid $200 for utilities, paid a utility bill. So your cash decreases by $200 and your expenses, utilities expense, increases by $200. Okay, and that's a separate account, utilities expense. The last transaction, the owner withdrew $5,000 from the business account for personal use. So the owner took $5,000 cash out of the business. Therefore, cash will decrease by $5,000 and owner's drawings will increase by $5,000. So if we look at the first column and we add the increases to our cash account and subtract the decreases, we have $14,500 cash on hand. Okay, after 8 business transactions, our accounts receivable, we add that's $900 in accounts receivable. The company has $500 in supplies. We add the supplies and we add the equipment that was purchased, $10,000 of equipment on the books, and we come up with a total of $25,900 in assets. So the company, is safe to say that this company has $25,900 in assets. Okay, so now let's look at the other side of the equation. Let's look at the totals here. So accounts payable, the company owes $500 for the supplies that were purchased on credit. So it's safe to say that the company has $500 in liabilities, $500 in debt, plus the owner's capital of $30,000 from the initial investment into the business, less the drawings, $5,000 drawings that were taken out of the business account for personal use. We want to subtract that from the equity, plus the revenue, because revenue increases equity, of $2,100 for the services that were performed for customers, minus the rent expense and utilities expense, which totals $1,700. That also gives us $25,900. So as you can see, the accounting equation is still in balance after 8 business transactions. This concludes the lesson on basic accounting equation. Please feel free to ask any questions in the comment section of this video, and I will do my best to respond and answer your questions as promptly as possible. Thank you, and I will see you soon.